Now we're going to talk a little bit about how to do your financial analysis when you're measuring credit risk. So you do want to still look at profitability. Profitability is very important. If the company is not going to make profits, then how are they ever going to pay you back? And you're going to use NOPAT just like you did before. And here you can see we're taking operating income here. And then they have all financing and investing items here. And we'll subtract the tax shields over here. So 4012 is the amount of tax, is the total provision for income tax, but you would want to take out the portion of income tax that applies to the interest. In this case, they had $753 in interest expense. So that means that they had some tax savings, some interest expense, and therefore your taxes on your operations were actually higher. And therefore your taxes on operations are whatever 753, I'm sorry, it's 4012 plus 753 times 37%. So that would give you NOPAT, net operating profit after taxes, of 7483. So we want to see the profitability that's related to credit. That profitability is related to credit risk in the sense that, as I said, the more profit you have, the more likely that they'll be able to pay the debts. If they're not going to be profitable, then there's no way they're ever going to be able to pay you back. And what we want to see is we want to look at cash flow also, because we want to make sure that they're going to have sufficient cash flow, which is related to profitability, in order to pay debt. You don't really pay debt with profits, you pay debt with cash flow. And we have what we call flow ratios because they're based on cash flow or income statement data. This is as opposed to balance sheet ratios, which are based strictly on figures on the balance sheet. So there are 4 flow ratios that you can use to measure interest and debt coverage. Times interest earned, EBITDA coverage, cash from operations to debt, and free operating cash flow to debt. So times interest earned would just be income before taxes plus your interest expense. You add it back in because usually interest before taxes, here you go, look at this for Home Depot. You see earnings before taxes includes interest expense has already been subtracted. So you want to add interest expense back into there and then divide by interest expense. And what this basically tells you is how many times over you would be able to make your interest payments. So ideally it should be 1, but it should be a lot more than 1 to show that there's a healthy margin. This would mean that there's room for the companies to screw up a little bit if there's a bad period. There's still enough room so that it can always pay its interest, because you only have to miss 1 interest payment in order to go into default. So you want to be very careful the company is going to have enough profitability, really enough cash flow in order to pay its interest. Another helpful ratio is what's called the EBITDA coverage ratio. EBITDA is something that analysts commonly use, and companies will sometimes tell you what their EBITDA is, but it's basically earnings before taxes, adding back the interest expense, also adding back depreciation and amortization. And the reason why you add back depreciation and amortization, you add back interest expense because it's not operating. You add back depreciation and amortization because these are non-cash expenses. So since a company doesn't need to pay for its depreciation, nor does it need to pay for its amortization, you can add them back and get a rough measure of what your cash flows from operations is like. And then divide it by interest expense. And again, you want this would be how many times over you could pay your interest expense. And EBITDA coverage is more helpful than the times interest earned because EBITDA in the numerator is a sort of a rough measure from cash flows from operations. And here you can see Home Depot's coverage ratios. They're very high. So for example, if their EBITDA coverage is almost 15, all right, here you go, it's almost 15 in 2016, that would mean that they could make their interest payments 15 times over. So that tells you that there's more than enough profitability in order for them to pay off their interest. Now another measure is cash from operations to total debt ratio. So we would take your cash from operations and divide by total debt. Total debt would include long-term debt and short-term debt, but it wouldn't include other liabilities. And the nice thing about this is that it measures the total debt as opposed to just the interest, because when you have debt, you actually might have to pay it back, and you don't just have to make interest payments. A variation on this is cash flows from is free cash flows divided by total debt. And what you would do here is it's the same as before, but in the numerator you put free cash flow. Free cash flow, there's a few different ways to measure free cash flow. What we're going to do is we're going to do cash flows from operations. That is net cash flow from operation that appears on the cash flow statement, and subtract capital expenditures. Now, students have a lot of trouble finding capital expenditures. Capital expenditures are payments for investments in fixed assets, equipment, land, buildings, and things like that. So you take cash flows from operations and you subtract from it investing cash flows paid for new equipment, land, buildings, and things like that. Because what you want to do here is you want to see not only how much cash do you have coming in from your operations, but you want to subtract from that any cash payments you need to make in order to keep your physical plant going. Because in order to make money, you have to have a certain amount of physical plant, and you have to occasionally make new investments in that physical plant. For example, if you run an airline, you don't just have operating cash flows, but you also have to buy new aircraft occasionally. So this accounts for that, and that's why free operating cash flow is so popular with investors. So here you can see the cash flow ratios, operating cash flow to debt, and free cash flow to debt as two measures of Home Depot's performance. Now we also have other liquidity and solvency measures that are based on the balance sheet. Liquidity, again, as I went into in an earlier chapter, is your ability to pay the debts that are due in the short term. Solvency is your ability to pay debts that are due in the long term. So they're really kind of the same thing, except liquidity refers to short term and solvency refers to long term. Current ratio is a measure of liquidity, and it's current assets divided by current liabilities. Both appear on the balance sheet. If you go, and you want this to be more than one, you should always have more current assets than current liabilities. And usually a higher number is better, but if it's too high, it means the company has just too many current assets that it doesn't necessarily need. Now, another measure is working capital, also net working capital. This would be current assets minus current liabilities. Here, this is actually incorrect. This should be not a division sign, but rather a minus sign. The quick ratio, as I said before, is a tougher measure than current assets, also of liquidity. And in the numerator, instead of putting all current assets, you would put just cash, marketable securities, and accounts receivable. You would not put in inventory or other current assets, prepaid assets, current deferred tax assets, because those are not as liquid as cash, marketable securities, and accounts receivable. You can pay bills with cash, marketable securities, and accounts receivable. You can't pay bills with inventory or deferred tax assets. So here you can see Home Depot's current ratio is fairly high, but their quick ratio is fairly low. And this is probably because the company has a lot of inventory. And their current ratio exceeds 1, which is healthy. The quick ratio might be a little bit low. I don't know. You can see that it was a little further down and a little further up. That's liquidity. Let's talk about solvency. Solvency is a little more long-term in that it focuses on all long-term assets. And again, the book likes liabilities to equity ratio or debt to equity ratio. The difference between these is liabilities to equity ratio uses total liabilities. Debt to equity ratio includes only debt. So it'll explicitly be called debt. And you would want to include long-term debt, current portion of long-term debt, and any short-term debt. Debt may also go under the name of notes payable, but it doesn't go under some other names. It's not a pension liability, it's not a deferred tax liability, and it's not accounts payable. Those are not considered to be debt. So all those liabilities would be included in liabilities to equity ratio, but they would not be included in the debt to equity ratio. So this focuses on long-term obligations, and this kind of tells you what the company's overall approach to risk management is. As I said before, I think the debt liabilities to equity ratio is a little confusing. Around 1 means that they have equal liabilities to equity. I prefer the liabilities to asset ratio, the debt to asset ratio, but that's not what the book uses, so we're going to go with the book here. And you can see here that restaurants have very little debt, have a lot of debt. The liability to equity, they have 4 times the liabilities for every dollar of equity. Whereas companies with very low debt would be newspapers, clothing and accessories, trucking, petroleum, and coal would be relatively low. But for some reason, restaurants are very high. So this liabilities to equity ratio would give you some idea of how much risk the company has. The company has a lot of financial risk when debt to equity ratio is very high, but it's low when debt equity ratio is low. And this gives us a sense of how much risk there is. So again, we have the liabilities to equity ratio, total liabilities divided by stockholders' equity, or we have debt to equity ratio, which excludes all those other liabilities. And here you can see Home Depot's ratios. Home Depot has a decent amount of debt. If you could see, they're stacking up the debt. And in 2013, they were relatively low, about 1.4. And by 2016, they're pushing 6, meaning that the company is taking on more and more liabilities, more and more debt, which means that there's going to be more and more financial risk. So you want to be aware of that. And if you were loaning them money, you would want to ask them why you're taking on so much debt, and you would try to understand that before you're willing to give them more.